Welcome to TheoTrade. This is Don Kaufman, May 8th, 2020, and you are watching the TheoTrade Weekend Update with a marketplace that can only be described, in my opinion, as gone to complete ludicrous mode. If you have no idea what that's a reference to, take a look at Tesla from time to time. Ludicrous mode is, it's just like it sounds. With that, here we are. 20.5 million people out of work, 14.7% unemployment, and a marketplace that continues to rally to the upside. Hence, a market in ludicrous mode. So let's actually dig into a little bit of the marketplace as a whole. One of the first things that's not necessarily on our list of items to discuss here has everything to do, though, with the market as a whole, and that happens to be the high correlation factor. So week in and week out, lately, you've heard me really discuss, just primarily about the market. I'll talk about the S&Ps, and I'll talk about tech, and I'll talk about different sectors, and I'm going to do much of the same today. In fact, I'm going to be talking about asset classes and bond and gold and index products and equities and dollar. Oh my! But you're not going to hear me talk a tremendous amount, maybe about individual stocks. And yes, I am taking positions in Intel. And yes, I'm taking positions, in a couple of the other tech stocks like a Facebook out there. But the point that I want to make is with the correlations as high as they happen to be, and this is a perfect place to actually start this conversation. Look, does it really matter where you're at? We're seeing a lot of sector rotation, but net, if the S&Ps are going there, if the if the Russell's moving, if the QQQs are moving, so goes the marketplace. Hence, we're not going to talk as much per se about individual stocks, but I am actually going to detail a little bit later in this update here my particular positions. So with that, a market in ludicrous mode. This market today, though, has just gone plaid. All right, with that. One of the first things I want to start with is not so much the unemployment data. Listen, everybody saw it, and you were expecting it because the initial jobless claims have been absolutely hideous. The initial jobless claims are up to like 33 million and counting. Push it all aside for a second. Even the most bullish of the bulls out there, they're becoming skeptics. You should be skeptical because you have a marketplace that's flying up. But what a lot of us are actually doing is thinking to yourself, it's the Fed, and we're going to detail the Fed. Don't you worry. The Fed is on the docket today as well. But it's the Fed. It's this. It's going to be a faster recovery over here. Listen. Pros in this marketplace, and what I want to have do is just an overall discussion of the market to begin with, but pros in this marketplace, and I say pros, I'm talking about market-making firms, I'm talking about proprietary trading firms, anybody that's massively large, what is actually construed as too big to fail. If you're not familiar with too big to fail, you missed the whole entire financial crisis. But if you take a look back at specific regulations inside of the Dodd-Frank bill. There's actually the Volcker rule, and most of that is actually still in play today. The Volcker rule actually says is that most of the too big to fail firms have to actually trade net, They're in large part net neutral. Well, they have to be what is actually called bona fide hedgers. That means that a lot of those big firms, they don't necessarily take I'm so bullish, I just want to buy the spiders. That's not what the big banks are going to do. They can't. They can make markets out there, but they have to be, for the most part, net neutral. That means their delta or the directional bias has to be net neutral. So in large part, retail is actually driving the bias of the marketplace. And you're like, that's a really scary thing. When I say retail, I'm talking about you. I'm talking about you. You're sitting at home. You've got nothing better to do. We're all on lockdown still. It's going to end soon. It's going to end to what? You're not going to be locked down. You're just not going to go anywhere for a long period of time. That's going to be most of us anyway. And I think everybody's, to their own devices. Nevertheless, retail, is really the driving force behind this marketplace. And there's so many people talking about, no, it's this, it's that. No, it's retail. In fact, if you want to see specifically, all you have to do is look at TD Ameritrade. And TD Ameritrade has the largest retail offering by far. And of course, they've just been acquired by Charles Schwab. What a behemoth that's going to be. But TD Ameritrade in Q1 In Q1, they opened over, 600,000 new accounts. Now, I happen to have a little insight to TD Ameritrade because I worked there. It's been 5 years, but I left there in 2015. That number is absolutely insane. The other number that's completely insane is if you actually look back at the previous month, TD Ameritrade was actually averaging, 3 million plus trades a day. 3 million trades a day. Now, everybody attributes that it's free commissions. It's not free commissions. Free commissions kicked off in October and November. Yeah, they bumped up the marketplace a little bit. But starting in like March, April, the number of trades have just shot through the roof. People are looking for opportunity right now. Kind of feel like maybe they've missed some of the rally of the last, 10 years. Nevertheless, retail traders are definitely pouring into this marketplace, and they're pouring in very large quantity. Now, what occurs, is if you turn around and buy, all right? So we have this professional trading firm, and this professional trading firm is trying to maintain some degree of delta neutrality. You go out there and you buy. If you buy, you're actually driving up price. If you're driving up price, what happens to this professional trading firm is they actually will drop out, to negative delta. All right, so if they're negative delta, how do they actually offset negative delta? By adding positive delta. Positive delta means that firm is out there buying. Because you're buying, you're actually driving the trading firms to buy. Because the trading firms are buying, what's it doing? It's running the market up, which means other trading firms have to turn around and buy. We're actually stuck in a cyclical rotation. Say what you will about the Fed, but the Fed isn't necessarily influencing the spiders. What the Fed is influencing is it's actually giving tremendous leverage capability to a lot of the trading firms. But frankly, I've been talking to a lot of the trading firms. They're a little edgy right now. They're edgy because, first of all, they they can't really get together. So for the most part, they're trading very autonomously. They're not trading as big a size as they normally do. And actually, that's really evident. Also, just take a look at the volume inside of the spiders. It speaks volumes. So as I said, TD Ameritrade, and I use that as the staple because there's just more people on that trading application than by far any place else. The sell side activity, trading firms are absolutely loving it. And the buy side activity, this is a retail wonderland. And again, it's on decreasing volume. So for the most part, retail is actually driving the bias right now. Question is, they're going to run out of cash. And it's a fair question. I don't know. I don't have an answer to that one. But I can tell you right now, the range is everywhere. Now I want to move right on to the next topic because everybody wanted to know why this is such a ludicrous marketplace. Well, you're buying it. And a lot of people, I'm not buying it. Believe me, people are opening up accounts, by fistfuls. They just can't even get enough. Like, they're opening accounts faster than anyone has ever seen. It's a gold rush right now inside of the brokerage world. Literally. There's articles written called The Brokerage Firm Gold Rush right now, and you're wondering why the markets are appreciating. And that's all fine and dandy until it's not. Again, it's a ludicrous marketplace. Now, the next thing that we got to discuss over here, this is really going to start to impact us, because as you see retail start to drive us higher, that's because the professionals aren't necessarily stepping in big right now. That could end, and I want to actually get to the potential. So the range is everywhere. When I say the range is everywhere, there's something I've been talking about extensively. I have been very nervous to allocate right now because we are inside, an extraordinarily tight volatility box. Now, a volatility box, if you're unfamiliar with it, trading inside of the same exact range for a full month. And then we're a full month now. Here we are. We're a full month to the day. So we're trading inside an extraordinarily tight range. You're like, who cares? Who cares? We're trading in a range. Who cares? I'll tell you why you should care. Because the longer you're in this range, the more positions, start to perpetuate in that range. What do I mean positions? Anybody trade any stock? Sure, putting them all on at the same exact level. Anybody trade any options? Absolutely. Guess what? You keep stacking more and more open interest at this particular level. What do you think it takes to hedge those option positions? Because the more option positions that you trade, the bigger the ball of risk gets. The bigger of the ball of risk gets, if we pop outside the range, how many S&P futures are going to be needed to hedge that? Because that's what the professionals do, right? They hedge using the S&P futures and so forth. So I'll tell you right now, you don't think this range matters? It's all that matters. We're in a volatility box. That volatility box can be absolutely vicious. As we're going to learn here in a moment, the potential is explosive. I'm going to come back to that here in just a second. But when I say all asset classes, they're in lockdown mode, just like you. And it's something that I think it's kind of ironic to discuss that. And I didn't just come up with that, terminology over there. It's the only terminology necessarily to describe this. When I say asset classes are in lockdown mode, let's actually cruise to some of the asset classes. Okay, asset classes. We start with the S&Ps. Clearly, you can see these things are range bound. Of course, everybody's it's a huge rally. Okay, have we really rallied in the last month? Okay, this is we're just towards the top of the range. We look at the year-to-date percentage over here, but I just want to clarify and quantify that when we actually locked into this range, okay, where were we? Okay, where were we? First of all, we're still down 10% year-to-date basis on the spiders. Okay, but at the beginning of this range, we were down 15%. Now we're down about what? 10%. This is a 5% range higher or lower. I don't care that you think that we're rallying. We're not rallying right now inside of the last month. We're oscillating back and forth. We're inside of a volatility box. Okay, it is what it is, and it becomes more and more dangerous. But all the asset classes right now are displaying this. And this is where I think people are missing it. Okay, I don't often look at this. Let's go look at the dollar. Well, I would say that the dollar is probably a little bit range bound. If I didn't know any better, that looks like a range. And this is where people are like, oh yeah, that is a pretty good range. Okay, this thing is ready to rock. All right, let's go over to the bonds. Okay, the bonds. Well, if I didn't know any better, okay, first of all, I blame the bonds. Okay, the bonds, this is where it actually all originates from. As soon as the Fed stepped in, they locked up the entire bond market. They locked up the bond market. Well, guess what? I'll come back to that here in just a moment because that's where things get interesting. The bond market right now is where I believe that this range kind of stems from. All right, so what else we got? So we just looked at the bonds and we looked at the dollar. And of course, the index products, right? The index products. And you can look at IWM. IWM's range is just volatile and vicious. Okay, IWM does actually look a little bit different than some of the other products over there, but the small caps, well, you know what? The small caps have absolutely gotten the crap knocked out of them. But the interesting irony with the small caps is you're thinking that they're not in the range. Okay, they actually are. And they were down about 27%. Now they're down about 20%. But it's just a little bit wider of a vol box in here. Okay, the only thing that's actually propping us up right now happens to be the NASDAQ. But the NASDAQ is owned. It's owned by, 5 or 6 different stocks over here. So the NASDAQ is, perpetuating some gains out there. But net, the S&Ps are locked in that range. The bonds are locked in the range. What else you got? The dollar's locked in the range. Let's go to gold. Okay, because commodity products, they have to be different, right? Gold, that's locked in a range because the dollar's locked in a range. I mean, everything is in lockdown mode right now. And you better respect this because now we're getting to the potential is absolutely explosive. Everything that you're looking at right now in terms of asset classes, and asset classes, I should say, that matter, are all locked up in this potentially explosive range. Because when we do finally crack the range, there's going to be a little violence in your trade. It's why I call it's the hurt locker. Okay, people constantly go for this, and you know what? I've mentioned this in the past, and I'll kind of mention it again. And if you haven't seen some of these ranges before, I can highlight a bunch of them for you. 2018 was a volatility box like Wonderland, right? Now these volatility boxes can resolve themselves higher or lower, but when they do, they are typically vicious moves. All right. And we've been in them again for extraordinary. I know these don't look like, long periods of time. Okay. Some of these are months, and they're months actually of volatility. But recently, the most prolific, I think, volatility box that we went into happened to be in late 2018. And I'll describe this one. Okay. We actually dropped into it and channeled back and forth. And we did it all the way from the beginning of October, I should say mid-October, right up until the point of what we kind of call the nightmare of Christmas, where we actually tanked into Christmas. This is actually a vol box that resolved a little bit lower. Okay. The one that we're in now is far worse. Okay, this one is far beyond what we saw back in December of 2018. Why do I call it worse? Well, I guess that's judgmental, but it's because the volatility is so high during this. Now, the VIX did drop off into the 28 handle over here, and the volatility futures are starting to finally back down a little bit. Speaking of the volatility futures, the 40-day is still above though the 75-day. The VVIX is still in Never Never Land, right? The VVIX is still trading 115. This is why I think it's a judgment call, but I believe that that ultimately this volatility box is substantially more dangerous than anything we've been in. And the other thing about this volatility box that it just reeks of danger is because all of the asset classes are locked up with it. Okay, I know you're going to say, well, what about oil? Okay, what about oil? Okay, you can call oil its own little hurt locker over here, but aside from going negative one day, oil too is in a relative range. Okay, if we contract adjusted it and everything, it is in a relative range. So now you got commodity products, you got bond products, okay, you got the dollar, index products. They're all packed in this tight little range. People, okay, we're ready to rock. Don't forget it. And again, look at the dollar. And that one's just amazing because that defines, if you will, what a volatility box is all about. The potential is going to be explosive. The one thing I caution you here, okay, keep your helmet on, because when we do break out of this range, I'll just give you a couple of scenarios for breaking the range right now, okay? And my inclination is not necessarily, higher or lower in here. I'll tell you exactly my positions in the next segment over here. But if we explode higher, hey, so be it. You better have some hedges on if you're short delta. If we explode lower, okay, you better be ready for it. Again, this is completely binary. It's a completely binary marketplace. This doesn't have to do with any economic news. It doesn't have to do with anything other than the fact that when we crack the range, it'll catch fire. Because once we're outside of that range, okay, all the hedgers have to add positive and or negative delta. Like if we crack to the upside over here, all the trading firms have to go out and add positive delta. They're going to light it up. And this thing is just going to fly. And the opposite is also true, okay, to the downside. So you have to be aware. Again, the range can crack on either side, and it's not what you think. Okay, I mean, I've seen times where the range was right up towards the top of this, right before it broke down. In fact, that was exactly what we saw in 2018. On the flip side, I've actually seen ranges right towards the bottom and then explode to the upside. Okay, it's all about delta here, and it's completely binary. Flip a coin, because again, get ready to rock. Now, bonds in this volatility box, bonds very well might be coming back to life, and they might be the defining factor. Okay, the defining factor in actually breaking this. So this is going to bring up a little bit of a talk of the Fed and the Fed balance sheet over here. But look, the bonds, flatline, they're dead. It was like literally, okay, somebody put them out of their misery just over a month ago, and I'll tell you exactly who that was. It was Jerome Powell. Okay. That is the tightest range pretty much recorded inside of like bond history. All the traders, they just backed away. Oh, the Fed owns me. Okay, you complete me. The Fed completely owns this marketplace, and you've seen some crazy stuff before, but we're in one of the most historic, places of a market, and the bond market completely locked up. It locked up, and this has happened actually in Japan with negative interest rate policy. There were actually days that went by that no one actually traded, like the Japanese 10-year. Literally, no one traded because the Japanese government, the Bank of Japan, went in there and actually, locked down all the liquidity. So nobody traded it. So a lot of that was happening here, at least believed. But all of a sudden, boom, we started to pop back up. And I'm going to show you precisely why I believe that's going on. So what you're looking at over here, this happens to be this is the balance sheet. This is it, okay? Federal Reserve System. This is the balance sheet. All right, so it's a party, people. This is the balance sheet, okay? And what's the balance sheet doing? We were cruising along. We were cruising along over here. By the way, this isn't trillions, but right there at about 4.25 trillion, and right at the beginning of this, we just absolutely accelerated it. They're now tapering. Again, they're tapering the bond buys on a week-to-week basis. There are actually weeks back here where we're doing, 75 billion. Get this, that's 75 billion a day. 75 billion a day that the Fed was actually going after. Okay, this next week they're going to be dropping all the way down to like 6 to 8 billion a day. So they've actually dropped off quite readily. And in fact, again, you can actually see it, all right there. So they're dropping it off. As they actually drop off, maybe traders, maybe just traders are coming back a little bit. By the way, just to compare this, if you haven't looked over time, okay, I'll even throw the financial crisis in here. There's the financial crisis. That was pretty serious. The financial crisis. Okay, that's just a distant memory, because what they're doing right now, foot all the way into the accelerator. But as you start to zoom into this, okay, and now I'm all the way zoomed in. They've really actually tapered it out. I think the Fed is actually, whoa, put on the brakes a little bit and see how things do, because we hit 6.5 trillion, on their balance sheet. By the way, again, just a few weeks ago, we're sitting at 4.25 trillion, but they're at 6.5 trillion, and they kind of slowed it. We're somewhere right around $6.7 trillion on the Fed balance sheet. But I wanted to show you that because the second that they started to kind of mitigate maybe some of those purchases of the debt, the bond volume started to come back. That's why I actually highlighted the volume. And as the bond volume started to come back, it doesn't look like much, but the last couple of trading sessions, the range started to pick up in the bonds too. Okay, so maybe the bonds are going to start rocking. I'd watch them very, very carefully. There was also a NIRP scare in the United States this week. A lot of people missed that. What is a NIRP scare? Negative interest rate policy. Some of the Fed fund futures rates went actually to display that we could in fact go into negative interest rate policy. We've already shown you the Fed balance sheet, but again, bonds, they come back to life. They're going to be the defining factor. If those bonds start to break range higher or lower, get ready, because that's the sign. That's when all of the products in here are actually going to break out of their volatility box. Now, my positions. Let's talk about it, okay? Because I wear my positions out there for everybody to see, whether it's good, bad, or indifferent. Okay, it is what it is. It's my positions. You don't necessarily have to carry them, but I'm going to reiterate something here that first of all, and I kind of wear this like a badge of honor. I am still reiterating something here. I want to be short delta, and people go, "Well, you're going to be wrong." Okay, listen, I'm not in here trying to trend trade this crap, right? I'm actually moving millions of dollars into this marketplace. And if I'm telling you I want to be short delta, okay, it's not because I'm carrying, a few thousand, short deltas here or there. Okay, I'm moving a few $1 million around in my positions in these particular accounts. I think I have about 700 grand in just these two accounts. I'm not fully allocated. Nevertheless, I still want to be short delta. But I want you to see, okay, my short delta is coming from tech. It's coming from XLP, Consumer Staples, coming from Costco, CSX, Home Depot. Those are some of the positions. I'll tell you another one that's not fun. I'm still short Lulu, okay? I'm short Home Depot, as I detailed up here, okay? Costco, I actually do have a position inside of Walmart, okay? And the XLP, again, XLP is Consumer Staples. I'm just giving you a few. And then when it comes to tech, what am I short in tech, okay? Intel. Now, in all the positions that I'm detailing over here, I'm short Intel, got a Facebook position on. Huh? Anything else? Okay. Of course. There's always more. There's always more where that came from. Okay. Look down the list, some of the usual suspects. Oh, yeah. Can't forget one of my favorite ones in here. I'm actually still maintaining a short position, okay, in Microsoft. And this is where you look at these positions, okay, and you're like, what are you, Don? Are you screaming out in pain? Well, on Lulu a little bit, okay. I'm getting yoga pantsed, okay? But at the exact same time, you got to recognize, okay, that I'm not just sitting out there short delta. So I'm a little bit long short. So my short delta, okay, you get it. I'm short some delta. But then I'm actually long delta in energy. So I'm long some delta in XLE and XOP. So if you take a quick look at a chart on those products. And by the way, my short delta is not being created by just going out and shorting Intel or shorting Microsoft. I'm using deep in the money puts, a synthetic short stock, okay? Then I've actually got some long delta in here, long delta, okay? Some long delta in there, some long delta in the XOP. The XOP has been rather explosive back to the upside as well. Where else? Okay, I've got some long call back spreads, some hedges on. One of my hedges is in XLF. Okay, the XLF. The XLF, interesting. Okay, it's actually kind of petered out here a little bit, but I believe if the marketplace continues to go up, this is actually a hedge. I'm using back spreads though. So if we crash and burn, okay, the back spread's not going to hurt me. The XLF, the EEM, the TLT. The TLT, by the way, just want to make this clear. The TLT is a back spread, but the TLT back spread happens to actually be bearish. So I don't know if it necessarily quantifies as long callback spreads. My TLT happens to be a put back spread for the downside, just in case the TLT breaks lower, interest rates break higher. And okay, because we're in such a tight volatility box, and I want to reiterate something, I'm using back ratios to the upside, and I want to kind of detail my bigger position here for just a second. All right, so there we are. Okay, now you know that net that I'm short delta. Here, right there, I'm short some deltas, which means I want this thing to resolve to the downside because that's the bigger position. But at the exact same time, I've got hedges up here. What are my hedges? Okay, those are the back spreads. That's where I'm actually sitting, okay, and backspreading. What are the backspreads in? And that's exactly where I'm saying. That's why they're in XLF, okay, EEM. There's a few other odds and ends, but I do have one in TLT. The TLT one, though, is a little unusual because it is a shot to the downside. So I'm trying to hedge off with some backspreads. I'm also hedging off with the XLE, okay, up here, and XOP. Okay, and on top of it, and I'll give you one more, when we break the range higher or lower, I actually bought a couple of iron condors. Again, bought a couple of iron condors, break higher or lower, and I'm going to be fine with that one. Okay, that's my net position right now. You know, love it or leave it. You don't have to like it. It's my position, but I'm comfortable actually taking you through it. Again, taking a little bit of heat and maybe a Lululemon, possibly a Home Depot over there, but I'm loving every minute of it. Last but definitely not least, the expected move. Last week, let's actually cruise over to the SPX for this one. Okay, last week we had an expected move of almost $107. Okay, so you just got to zoom in really tight to actually see how efficient this marketplace all of a sudden became. Okay, so when I say efficient, look, the week before, we seem to adhere, and let me make this a little bit brighter here. We seem to actually adhere right there to the edge of the expected move, and then we pulled back in on the week. This week, we came right up to it, people. We missed the edge of the expected move by a couple of bucks because what happened was there was an expected move of 107. The actual move, okay, was like 99. So basically a $100 move to the upside. But here's the crazy thing. They dropped the expected move, okay, below 80 bucks this next week. I'm telling you, that's low. That's the lowest expected move we've seen. And I caution you, okay? So markets do have a degree of financial memory, okay? But when it comes to expected move, and here's something I've been talking about a lot, 11 out of the last 17 weeks have seen moves outside, okay? So if you think about expected move is all about standard deviation. And you're supposed to be inside here 68% of the time. But right now, 11 out of 17 have actually cracked out here. It's been Mr. Toad's wild ride. But I still believe that overall, the marketplace moved from incredible efficiency, okay, into a period of wild inefficiency. And even though this last 2 weeks of trade has shown, all right, things kind of calmed down, okay, I don't like it. And I'm going to tell you right now exactly what I feel. You got 1, you got 2, you got 3, you got 4 weeks in a row inside the expected move. Get ready to rumble, okay? And it doesn't mean on the 5th week you wake up and boom, we break higher or lower, okay? But again, okay, you can feel it right now. Market is still completely abnormal, okay? It just doesn't feel right. There's still low bid offer spreads inside of like S&P futures. Okay, bid offer spreads throughout the marketplace are just strange. Liquidity is crap right now. It is a market in ludicrous mode, and I think you're going to find out precisely what that means in these next couple of weeks as we blow through this volatility box. Listen, on that vol box, don't be surprised if we break to the upside only to flip back around. Okay, there's one thing, and that's this. Okay, sooner or later, the fundamentals of a marketplace will eventually wreak havoc on the marketplace. Okay, the Fed, yes, they're influencing the bond market. Yes, they're buying corporates out there. Okay, yes, that has some impact, okay, on the overall market. But sooner or later, okay, the market itself may trade against that Fed. Thanks everybody for joining us here at TheoTrade for the weekend update. Have a wonderful weekend. Bye-bye.